Aloha, everyone. Mahalo for joining us today for our webinar, especially as the state of Hawaii is under a tsunami watch. So thanks for sticking in there with us. My name is Janelle Lyman, and I'm the Director of Plan Giving and Advisor Relations at Hawaii Community Foundation. Before I introduce our speakers today, I just want to say Gung Hi Fa Choi. I can't believe today is March 4th. In the Chinese calendar, 2021 is the year of the metal ox. The ox symbolizes stability, and as we look ahead, this year will not be a year to sit back and relax. It will be a year of hard work, careful planning, and persistence. The year of the ox will be a powerful time of moving forward. Coincidentally, the word that I chose for myself to set the direction and intention for 2021 is holomua, to move forward, to progress. Today, our speakers will give you a glimpse of what moving forward and looking ahead will look like in 2021 for charitable giving. I'm honored today to introduce our speakers. Starting with our first speaker, Catherine Kate Lloyd. Kate is a Senior Vice President and General Counsel at Hawaii Community Foundation. She has been with HCF for 15 years. Prior to HCF, Kate served as the Senior Vice President and Division Manager of First Hawaiian Bank's Trust and Investment Division. And before that, a partner at the law firm of Ashford and Riston. Kate's word for 2021 is gratitude. Kate is grateful for family and friends, new beginnings, for health, for kindness, and for science. Our next speaker is Kavena Beaupre. Kavena is the Senior Director of Gifts and Compliance and Associate General Counsel at Hawaii Community Foundation. Prior to joining HCF 7 years ago, Kavena was an associate in the law firm of Kate Shetty, where she practiced in the areas of tax and finance. Kavena's word for the year is ho'oulu, to grow and flourish in mind, body, and spirit. Kavena hopes to help those around her to grow and flourish in 2021. Our third speaker is Michael O'Malley. Mike is a partner at the law firm of Goodsell Anderson Quinn and Stifel. Mike has over 38 years of experience representing for-profit, nonprofit, and healthcare clients in the area of business and tax law. Mike's word for the year is kokua, help. Mike likes to kokua his coworkers, clients, family, and friends, and he needs all of their kokua as well. We are grateful for Mike, Kate, and Kavena and their kokua as we grow ho'oulu and learn about charitable giving landscape in 2021. Today's presentation is being recorded, and we will email you the link and the recording and a copy of today's slide deck, or you can check back next week on our advisor page on our website. We'll post the information there. As always, we encourage questions, and we have gifts to send those that are brave enough to ask. So please use the chat box at the bottom of your screen and send your questions there. I'll be monitoring the box, and we'll take live questions throughout our presentation. As we move forward in our presentation, Kate will first give us a look at the giving landscape after the Tax Cuts and Jobs Act. She will also discuss continuing trends post-Secure Act. Next, Kavena will discuss how the CARES Act and COVID-19 affected philanthropy in 2020. Kavena will also guide us ahead to CARES Act 2. And finally, Mike will review and discuss Biden tax proposals and what that means for charitable giving and estate planning moving forward. So without further ado, I'll turn it over to Kate.
Thanks, Janelle. Hello, everyone. Welcome. And as Janelle said, thanks to all of you for coming out today. I'm going to start with a little bit of a look back. I'm the oldster on the team, so they always test and see what I can remember. And I'm going to go back. I'm going to start by going back as far as 2017. Hard to believe it was really that long ago, but I'm going to start with the Tax Cuts and Jobs Act. And we just want to sort of review a couple of pieces of prior legislation because they continue to have impacts on charitable giving today. And the Tax Cuts and Jobs Act, not a charitable piece of legislation really, but it did a couple of things that were really important to charitable giving. Couple of negatives, couple of positives. The first one, doubled the standard deduction. You know, really it increased to $24,000 for a married couple. The other thing it did that we anticipated would be a negative is it compressed the brackets, lowered the top bracket down from almost 40%, it was like 39.6 to 37%. The other two things it did was it eliminated the P's phase out. I don't know if you'll remember those, but it's sort of a complex formula that they applied to high net worth donors. And it sort of decreased the impact of your charitable gifts, or actually all your charitable and itemized deductions. And then the other thing that was sort of seen as a positive is it increased the percentage limits, the amounts you could deduct from 50% to 60%. That's been further changed. We'll chat about that. Next slide, Joanne. So the predictions, you know, when Tax and Jobs Cuts Act came out, there were some pretty dire predictions about how those changes would affect charitable giving. They predicted that the number would go down, both of people who give and itemizers. There are some dire predictions about the amount of philanthropic giving. And that was because there was a fear that the loss of that ability to itemize and therefore give a tax motivation would really have a negative impact on giving. You know, this has been an issue for a long time. Do tax incentives motivate giving? In our experience, they don't motivate charitable giving, but they do motivate folks to give more. And so we were really concerned about this. The other reason that they were concerned about the impact is that as the rates decrease, the tax cost of charitable giving increases. So, you know, simple way to think about that, if I'm at the 40% rate and I give $100, that costs me 60 cents or $60 to give that gift. If I'm at a 37% rate, it costs me $63. So, you know, not huge changes, but when you're talking about big, giant, multi-six-figure gifts, the tax cost can be a real impediment. So we were really wondering to see, boy, what is the TCJA going to do? Next slide, Joanne. So reality, of course, the number of itemizers dropping, that did happen significantly. Prior to TCJA, they had almost 50 million or 46.5 million people who itemized. After that, only 18 million. So huge drop in the number of people that itemized. But the dollars, they did drop slightly in 2018, but they rebounded in 2019. And as you'll see, they're just coming back in spades. So I'll show you a little detail on the giving. Next slide, Joanne. So this is a slide from USA or Giving USA. And what it shows you, it's sort of a historical perspective of giving from 79 on. And you can see that in 2017, there was a spike, a slight decrease in 18, and then back up to historical all-time highs in 19. And what they're attributing that to is in 2017, when TCJA came out, people were concerned, you know, am I not going to be able to itemize next year? Am I going to lose the value of my deduction? So what we saw was a lot of bunching, people bunching or timing their charitable gifts and other itemized deductions, but charitable gifts in particular into 2017. That continues to be something we see today, and it's mostly accomplished by the use of donor-advised funds, still a super popular vehicle, adds a lot of flexibility, but we are seeing more timing with charitable giving than we have before. Then you saw that drop in 2018. Most of the folks attribute that to the fact that people sort of preloaded or front-loaded their charitable gifts, and so that slight decrease was due to that, not necessarily tax motivated, and then jumped back up to 2019. And then as you'll see a little bit later, we're just going up and up and up. So the dollars, unlike the number of itemizers, did not go down. Next slide, Joanne. So this one, the next slide is just, I thought, a little bit interesting. It sort of shows you charitable giving by source of contributions. Individuals continue to be by far the largest share of where our contributions are coming from, but that number is dropping. It's now at 69%. In the past, it has been as high, I think, of even 75 to 80% in the distance past. So that's just sort of a trend, you know, to kind of keep your eye on. Next slide, Joanne. I think the real trend that we're watching with some interest is, while the dollars themselves are not going down, what's happening is there are fewer donors and they're giving more dollars. And so this is a slide that shows a review of trends between 2017 and 2020. You can see a decline. That's a decline in the number of households. So you see a decline in all those categories, but only 5% decline in the number of households at $100,000 or above, considered high net worth in this Gallup study. Big decline in the households less than $40,000. It's a small study, only 3 years. There may be other factors at work, but it is an evolving trend that I think those of us in philanthropy are watching, is that fewer and fewer donors are giving bigger and bigger dollars. And so for the fundraisers in the group, you know, they all know what that means, which is increased competition, and also the fact that high net worth donors tend to give a little bit differently than their low net worth or low income donor counterparts. Okay, so switching a little bit from TCGA over to Secure Act. That's another act that was in 2019, continues to have some impact on charitable giving, but was not in itself a charitable giving piece. It was actually intended to address a fear that people were not saving enough for retirement. And it did a couple of things. It pushed out the required minimum distribution requirement from age 70 to 70 and a half. And then it also allowed folks who were continuing to work after age 70 and a half to contribute to retirement plans. And like I said, those in and of themselves are not charitable issues, but it added some complexity to a super popular vehicle, which is the qualified charitable distribution, or the IRA rollover. And just sort of quick review, the IRA rollover allowed me to, if I had to take an RMD, it allowed me to instead direct that money directly to a charity, never recognized in income. It satisfied my RMD requirement. I never took it into income, so I didn't get a charitable deduction for it, but it's in essence like 100% charitable deduction. So kind of a new technique, super popular, continues to be popular. We're seeing a lot of these, but just be a little careful after the Secure Act, because if your donor does contribute post age 70 and a half, it's going to make part of that QCD non-qualified. So there's some technical offsetting rules, but I think the takeaway is be careful if you're trying to do both, contribute after age 70 and a half and do a qualified charitable distribution. I'm going to stop there because I think we had a question on QCDs. Janelle, do you know?
Yes, we did. Yes, we did, Kate, have a question on the QCDs. And the question was whether if you could review some of the gift options from the rollover IRAs from QCDs.
Okay, got it. Thank you. And I think that speaks to the fact that, so QCD, like I said, it's a direct distribution to charity, but you cannot do an IRA rollover to a donor advised fund. You cannot do one to a private foundation, and you cannot do one to a support org. So it has to be a public charity other than a a donor advised fund held by a public charity. So I'll stop there and see really quickly if there's any questions. And hearing none right away, I will go on to the other part of the Secure Act, which affected charitable giving, and that was the sort of elimination of what was known as the Stretch IRA. And Stretch IRA used to be a planning device that was used to pass money to heirs very long term and was a tax advantaged way to do that. As a result of Secures Act, unless you're going to give your IRA, you're going to name as a beneficiary one of those designated folks that are on your screen: surviving spouse, minor child, disabled or ill beneficiary, or a beneficiary that's 10 years younger. Your limit is 10 years. And so what it did was it made the IRA asset, particularly after the death of a surviving spouse, a very tax disadvantaged asset to use. And so what we're seeing as a result of that is we're seeing an increased number of donors who are naming charity as the successor beneficiary, typically to a surviving spouse if they're married. So we take the disadvantaged tax asset, or the other charity does, and then they're using other assets within their estate plan to leave to heirs because they don't carry that huge sort of tax burden. And we expect this trend to continue. It's a simple way to give, and it, like I said, it eliminates some of that tax disadvantage. So I am going to stop there if there are no questions, and I'm going to turn it over to Kavenna, who's going to take us into current day.
Okay, thanks so much, Kate. As we continue on this look back journey, I first wanted to cover, I'm going to cover the CARES Act, but I wanted to first just do a quick timeline review to help us remember what happened in the beginning of the year, because we know 2020 changed very drastically for all of us. So on January 21, that's when the first case of the coronavirus was confirmed in the US. And in about 6 weeks later, and almost exactly 1 year ago to the day today, on March 6th, Hawaii confirmed its first case of the virus. On March 11th, COVID-19 was declared a pandemic by the World Health Organization, and then Trump declared it a national emergency. And this all brought about the enactment of the Coronavirus Aid, Relief, and Economic Security Act, otherwise known as the CARES Act, in late March. It's the largest economic recovery package in the history of the US, provided over $2 trillion in aid, much needed aid at this point. And as you can see on the next slide, the CARES Act included some tax relief and charitable giving benefits for 2020. The first is it allows those who take the standard deduction, which is really almost, I think, 90% of taxpayers today, to get a deduction of up to $300 for a qualified gift to charity. And this is referred to as the universal charitable deduction. It's an above the line deduction, as you can see, which means that you subtract the gift amount from your gross income before arriving at your adjusted gross income. And this deduction only is allowed for cash gifts, and it has to be made to a public charity or an operating foundation. It does not apply to gifts made to a donor advised fund, a supporting organization, and non-operating foundations. So this rule really affects limited charitable deduction to the vast majority. Universal deduction is actually something that the charitable sector has pushed for a very long time. And even though it's a small amount right now, we're hopeful that it's going to stick around and that it will increase. On the next slide, you'll see that the CARES Act also lifted the cap on cash contribution. As Kate had mentioned, in prior years, it was raised to 60%. For 2020, the deduction is raised to 100% of AGI for cash gifts. And it only applies for gifts made to a public charity again during calendar year 2020. So it doesn't apply to gifts made to donor advised funds, supporting organizations, and non-operating foundations. The last thing that the CARES Act did was it temporarily suspended the requirement minimum distribution, the RMD, from IRAs and other retirement savings plans for 2020. So this means that anyone who turned 70 and a half in 2019 and would have had to take their RMD by April 1st of 2020 could skip their RMD for that year. And I wish, we had more stats on how this CARES Act affected taxpayers and the nonprofit sector. But at this point, it's too early since we're in the midst of tax season, but hopefully we'll get some statistics on that soon. I'm going to shift gears a little bit and talk about how COVID-19 has affected philanthropy. A survey done by Fidelity Charitable in March of 2020 found some key takeaways regarding donor behaviors amid the pandemic. So 54% of donors said they plan to maintain their giving levels, and 25% actually said they plan to increase their levels in 2020. This is kind of interesting. Almost half of the millennials that were surveyed said that they feel, or they said that they would give more in response to the pandemic compared to baby boomers and Gen X. And about 43% of donors said they'd continue to support their favorite charity as opposed to switching gears and giving to charities that were specifically addressing COVID. Donor advised funds were more likely than general donors to ramp up their giving. And as you can see on that chart, 58% of donors said that they would keep their giving local and support domestic, while 11% plan to give globally. The 2019 total for giving was about $450 billion. So this is our baseline going into COVID in 2020. And a charitable giving report that just came out recently reveals that for 2020, charitable giving actually increased by 2%, which means that the total is actually $459 billion raised for philanthropy in 2020. It's interesting to note that online giving grew by nearly 21%, and a record of 13% of fundraising came from online donations, which makes sense because it mirrors, online retail sale trends. I also thought this was pretty interesting. 28% of online gifts were made from this thing, our mobile devices, and people gave more than prior years, with overall donations averaging about $700 and online donations at almost $200. With regards to funding that's specific to COVID relief, a report by the Center for Disaster Philanthropy and Candid found that during the first half of 2020, almost $12 billion were given in response to the pandemic. And I just saw a report come out yesterday, actually, that said that over the figures actually 20 billion for the year 2020. So, this is, if you can see on the chart, this is far exceeds, that disaster relief giving in past years. And the trend that we are seeing, or at least the report is seeing, is that community foundations awarded more grants than any other grant maker. And I think, as Kate had pointed out earlier, it's a little bit different in that corporations accounted for nearly half as compared to individuals in prior years, but closely followed by high net worth individuals and private foundations. And a significant amount is also coming from donor advised funds. And the relief is going mainly to hunger and human services organizations. They're taking the largest share of the funding. On the next slide, just to cover what's happening here locally. So Hawaii Community Foundation responded with the creation of the Hawaii Resilience Fund. And this raised over $12.2 million. In total, we granted out over $77 million specific for COVID relief, and $3.4 million of that came from our donor advised funds. And unlike the national trend that Kate had mentioned, we actually saw a lot of small gifts, but coming from many donors, with 70% of donations being under $1,000. But we saw an uptick in the number of donors that were giving, and many of them were donors that we had not had a relationship with before. And so all in all, we had a really stellar record year which ended with a $10 million gift from Mackenzie Scott. And this is in line with the trends mentioned earlier. This is one of the largest single lifetime gifts that Hawaii Community Foundation has received. And it's kind of interesting because we had no prior relationship with Miss Scott, but we think that the gift was largely attracted because of our work with the Hawaii Resilience Fund and the confidence that her vetting people had with the Hawaii Community Foundation. Before I turn it over to Mike, looking forward, I wanted to cover CARES Act 2, which just was enacted at the end of December of 2020. So it does extend the universal charitable deduction for 2021. So those who take the standard deduction can deduct up to $300 for cash gifts to public charities. And it also clarifies or expands this to allow a $600 deduction for taxpayers filing a joint return. It also allows those who itemize to take 100% of the AGI limitation deduction for a charitable contribution of cash to a public charity. One thing it didn't extend was the waiver of the required minimum distribution. So that is not in effect for 2021. On this last slide, it's just to cover the strategies that we talked about and to keep in mind for charitable giving and your donors that you can review later. But before I pass it to Mike, I wanted to see if Janelle had any questions that came through.
Yeah, there is some questions and actually a clarification. So yeah. With regard to the Secure Act, the clarification is that it pushed out the RMD age from 70 and a half to 72.
Yes.
And then there's actually two questions for yourself and Kate. The first question is, I guess for you, and the question is, can you still do a QCD even though the RMD is suspended in 2020? Or
yes.
Suspend 2020, 2021, right?
Yeah, so the RMD It's an opt-in to waive. It's not a requirement that it be waived for 2020. So if you decide to take your RMD for 2020, you could still do a QCD.
Okay. And then the question for Kate on that QCD is there a tax benefit in making a QCD versus taking the RMD and writing your own check to the charity?
And thanks, Janelle. I did see that question, and I guess the answer is maybe. You know, it kind of depends, and you're going to have to run the numbers on both of that, because a lot of it depends on, are you going to be able to get up over the standard deduction and take it in any case? And of course, if you aren't, then take the QCD because it allows you to roll over directly. And then it also can have an effect on your total giving, and so it can subject you to a little bit more Medicare tax. If you're going to take it into income, you'd get a charitable deduction for the income tax part. So it can be a slightly better tax advantage if you just go ahead and do the direct rollover, but you really got to run the numbers if you are otherwise able to itemize. The other one, one of the participants asked if sort of we hadn't made a mistake on the CARES Act, and that's because we had referred to the owner turning 70 and a half in 2019. And that one was a real, Covet and I talked about that. That slide actually is correct, because the push out of the age to 72 did not happen until 2020. So if you turned, correct me if I'm wrong here, Kavena, if you turned 70 and a half in 2019, you may have still been required to take an RMD in 2020, forgetting the Secures Act. And so what the CARES Act did was come along and say, we'll suspend that for you. So a couple of things, different things going on there.
Yeah.
Okay, no other questions. So thank you both. And we're on to Mike.
Good afternoon, everyone. I'm going to talk about the Biden tax proposal. So I actually have the easiest part of the presentation because there are no proposals. Nothing's been introduced. Everything I say as of today is true and correct, and you can't prove me wrong. But we will talk about what's out there on the horizon. And not surprisingly, it's raised taxes. This is all guesswork. Nothing's been introduced yet. And then we have a 50-50 Senate. Normally tax legislation requires 60 to pass. That's not likely to happen without some back and forth. And then the other thing is I think President Biden currently is just tied up with other things. I don't know that this is a great time for him to be introducing tax increases on the economy. The betting public is that he's going to wait to introduce later in the year, maybe. So we got to stay tuned. But the things that have been floated informally on his behalf are raising taxes on individuals with income above 400,000. 400,000 seems to be the boogie these days. Above that, you're rich. Below that, you're not. We can all laugh about that a little bit, but that seems to be a number you'll see pop up all across the board. So he's going to raise taxes on individuals. Currently, the max was lowered to 37. He put it back up to the prior 39.6, which I would point out is still historically a very low top marginal tax rate. So notwithstanding all the gnashing of teeth and complaining about taxes, et cetera, they've never been as historically low as they have been in the US over the last decade or so. And that raises other social issues, et cetera, that I'm not going to comment on, but just understand that in the context of history, these are still low rates. He's also planning on increasing taxes on capital gains and payroll taxes. Those are probably more significant. We'll get to that in a slide down the road. And then he's talking about raising the corporate income tax. Before Trump reduced the Trump Tax Act, the US corporate rate, federal corporate rate was 35%. way out of whack with the developed world, way high. And people wondered, well, why did American companies want to redomesticate and have their principal headquarters on the Isle of Man or Ireland and other places? And it's because the US tax rate was just too darn high. But what Biden is proposing is not to go back to 35%, but to raise it to 28% from the current 21. So we'll see. He's also introducing a proposal, or expected to introduce a proposal to impose a corporate alternative minimum tax, but based on the corporation's minimum book tax. So a lot of these corporations, because they pay smart people like those on this panel to advise them, they can show great income and results on their financial returns and look like paupers on their tax returns. And so this attempt to impose a corporate AMT based on minimum tax, it kind of reflects that reality. The last thing I'll say about the process of tax reform is people would expect that Biden's going to use what's called budget reconciliation process. And what does that mean? Well, I said earlier that it takes normally 60 senators to pass a tax bill. There's an exception to that, and that's budget reconciliation. And it involves manipulating committee reports and budgets. And when you have the Senate Finance Committee and another committee come out with different budgets, then at the last minute, you do what's called budget reconciliation, and you're allowed to pass those reconciliations by a simple 51% majority. And that's in fact how Obama got his tax act passed. That's how Trump got his tax act passed. And that's how people expect Biden will get his passed. You're only allowed to use that parliamentary procedure once. So keep your eyes peeled on budget reconciliation. That's probably what's going to happen. Next slide. Okay, so the macroeconomic effects, the earliest handicapping of the things that Biden is proposing suggests that it's going to raise tax revenue by a whopping 3.3 trillion. It says over the next decade. It should have just been singular, over the next decade. 2.8 trillion, that just means that we have rebound effects, et cetera. The true cost is something less than the immediate off the top, but it's still going to be a significant tax increase. The negative impact on GDP, gross domestic product, is projected to be 1.62%. That's not insignificant. They're reflecting the different approaches to who gets what by the two different parties. The after-tax income hit for the top 1% is going to be 7.7% reduction in their after-tax income versus a 1.9% decline for most taxpayers. But I would point out that of the huge amount of tax relief that came in the Trump Tax Act, 85% of the goodies went to the top 1% of the earners. So it's only fair, it seems, that they give back some of that if we're going backwards. I'm going to say this aside. We're talking about tax policy at a charitable community foundation presentation. And I think we're finding out just from some of the earlier slides and from some research I was doing, tax doesn't really drive charitable giving as a primary driver, but it can affect the amount of the gift or the nature of the gift, et cetera. Really, it's GDP and the S&P 500 are both greater indicators of charitable giving. And then, even in this tough COVID era, the stock market's been doing real well, and so charitable giving surprisingly is up. Americans are also very generous, period. Next slide. Okay, so some of his proposals, one is to impose a big 12.4% Social Security payroll tax on earners earning above $400,000. That's quite a jump. That's old age and survivors and disability income. That's OASDI. The proposal currently contains a donut hole, which just basically means that in the jump between 137,000, which is the current cap on that particular payroll tax, and 400,000, nothing would be taxed. But once you go $1 over 400,000, then you're going to get taxed. So that's one to keep your eye on. That's pretty big. And who knows whether any of this stuff gets exactly passed. The second one I mentioned, raising the top rate from 37 to 39.6. Kind of hard to argue with that when you get guys like Warren Buffett and Bill Gates admittedly coming out and saying, yeah, we're not getting taxed enough. I think there's probably going to be appetite for raising that. The next one is pretty extraordinary, and that's to tax long-term capital gains and qualified dividends as ordinary income, at ordinary income rates, because currently those qualify for the 20% capital gains rate and 20% on qualified dividends. So if you're an earner with income of $1 million or more, you would pay 39.6% on capital gains and qualified dividends. That one I find hard. I would be really shocked if that one's passed as proposed. I mean, it sounds like a populist, type of proposal, but the impact it would have on markets and everything else, who knows? That sounds pretty crazy. The last bullet point, I apologize. I should have said eliminates a step up in basis for capital gains on death, not step up in basis. But those are the sorts of things that are being proposed. Next slide. Expands the new markets tax credit, which has actually been pretty successful, and it's going to make it permanent. Offers new tax credits to small businesses for adopting workplace retirement savings plans. We have a tremendous amount of gig and other workers in this company that have no retirement, and relying on Social Security is, as we all know, it's just not going to be sufficient. Expands renewable energy credits. I mean, he's moving away and he's ending subsidies for fossil fuels, restore the energy investment tax credit and the electric vehicle tax credit. Those are all typical type of Democratic platforms, but that's what's being floated. Next slide. Capping the benefit of itemized deductions to 28% for those earning 400,000 or more. So that would include charitable contribution deductions. So, we're really used to various phase-ins and phase-outs and limitations based on adjusted gross income, et cetera. This is another one of those. And all of these understand that when we get to the actual writing of the act, it's all going to be based on budget projections and balanced budget requirements. So the way these things typically work is they're phased in and they drop dead and what have you, because no one's able to pass indefinite tax change these days without running afoul of the budget balance, the Balanced Budget Act requirements. And then as Kate mentioned earlier, Biden would restore the P's limitation on itemized deductions. Basically what that does is for every dollar over a threshold, I think the current threshold for married is 350,000 or something like that. There's a 3% deduction for every dollar, a reduction in the deduction for every dollar over that threshold amount. So again, it's one of those things that as you make more money, they take away more tax goodies from you. It would phase out the qualified business income deduction. That's the 20% off S-Corp and partnership earnings for taxpayers. Again, $400,000, that's the magic number. Would expand the earned income tax credit for childless workers. Would provide renewable energy related tax credits for individuals. Next slide. Would expand the child and dependent care credit from $3,000 to $8,000, $16,000 for multiple dependents. I cry when I read this stuff because I have 7 kids and 8 grandkids and I didn't get nothing. So I'm going to ask for a rollback in the effective date. But this is obviously aimed at helping low income earners and families that are struggling. Reestablishing the first time home buyer tax credit, provide a $15,000 credit to first time home buyers. And then estate and gift tax, which probably has more impact for what Community Foundation does than almost anything else. They would restore the rate and exemption to 2009 levels. Basically just push back things to the way they were before. The possible reduction of the federal estate exempt tax, the exempt estate from 3.5 to 5 million. That's been floated. It's currently 11.7, but as you reduce the exempt estate, you increase the estate tax take. Frankly, if that were to happen, I think a fair amount of the attorneys in this audience will be busier doing the traditional estate planning that we haven't been doing quite as much of. There's also a proposal that Kate identified, and I think I did too, floating in the current state legislature, which would reduce the estate, the exempt estate for Hawaii purposes to $1 million, which seems crazy because we all know the ridiculous value of our homes. It would make all of us have taxable estates, or a lot of us have taxable estates, if it went down to $1 million. Like I said, it would eliminate the step up in basis at death. And there's also some changes to 1031 exchanges that I won't get into. Next slide. Increase the corporate tax rate. I mentioned that. Corporate minimum tax with book profits. That's one. If you have book profits of $100 million or less, see, this is the one that's hard. This is a political thing, because when you're showing on your financial books that you've made $100 million or more, and you're paying really tiny tax because of the disjoint between financial and tax accounting, that's what this is aimed at. Doubles the tax rate on GILTI. GILTI is basically where you put the ownership of a patent in a low tax jurisdiction, and then you license out the use of that patent to all the different related companies in high tax jurisdictions. And so you move the profit related to that intangible to a low tax jurisdiction by that manipulation. And there's been a lot of that going on. And this would attempt to capture some of the tax reduction that achieves by doubling the tax on that from 10.5% to 21%. He wants to establish a manufacturing communities tax credit. A lot of stuff aimed at middle America and blue America remains, a lot of the details are missing, so we don't really know what he means. A new 10% surtax on corporations offshore. These are the guys that go and they have a subsidiary in a low cost jurisdiction, build and manufacture the product, and then it's re-imported to the United States. And this would basically try and tax that and capture the tax escape that's happening. This is kind of one of those things that's, it's almost bipolar, because the reason this is all happening is because of high US corporate tax rate. So when you increase that corporate tax rate, we're going to see more of the offshoring stuff going on that this is intended to attack. If you didn't have such a high corporate tax rate, you wouldn't have to worry about this so much, but it's tax policy, so it doesn't always make sense. And then he's talking about advancing a 10% quote, made in America tax credit, intended to restore production and retooling and fixing of America's manufacturing capability. I don't know that a 10% credit will do that, but we'll see what happens. And then he's talking about trying to equalize tax benefits of traditional IRAs, retirement account 401ks, IRAs, by providing refundable credits versus traditional deductibility. The details are not out. We'll see what happens. Eliminating certain real estate industry tax provisions. And this will be a political statement, but boy, not surprising that President Trump had a lot of goodies for real estate in his tax act. How did he make his money? What's his industry? It's real estate. So there's a lot of things aimed at repealing some of the things that happened under the prior act. Expands the Obamacare premium tax credit for health insurance. Would create a refundable renters cap, capped at $5 billion per year. I don't know how that makes a hill of beans, but that's what it says right now. Increase the generosity of low-income housing tax credit. That works. We have a fair amount of those projects in Hawaii and elsewhere. The impact on giving, who knows? I mean, I would have thought that 2019 would have gone down given just tax changes in the act, but we found that it went up because my statement earlier that it's not tax policy that really drives giving to begin with. And then I'd like to just end by giving you a couple of forecasts by guys who look at this stuff all the time. The number one, they forecast that gross domestic product is likely to rebound later in the year because of vaccines. Overall giving should rise by 4.1% this year, they say, over the prior year, and 5.7% in 2022. And then they break it down by individuals, foundations, estates, and gifts. But across the board, giving is expected to go up. And then the last observation I will leave you with has to do with what I found when I was doing some research of the Stelter group, who does a lot of commenting in this area. And what it found is boomers still rule in the giving community. We comprise 39% of the population, but we control 80% of the wealth, and we give 50% of individual philanthropic giving. We're 1/3 more generous than our parents were, and we're going to maintain economic inequality for next 20 years because we're not retiring, whether because we're living longer or we can't retire, I don't know. But boomers are still the key demographic in the giving space. And then the last thing we all kind of know, we know that here intuitively, and that's that 7 out of 10 donors give locally. We want to give to local stuff. We want to give to local causes. And we saw that in spades here over the last year or so. And with that, I'd be happy to try and address any questions if there are any.
Hi, Mike. There are a couple of questions for you. The first question, what was the 2009 level of estate tax? Do you know that?
You mean the estate tax?
Exemption.
Exemption at 2019, it was 11.7 million.
Okay, and I think one of your slides says it's going to go back to the 2009. One of the proposals were supposed to go back to the 2009.
Yeah, that was a proposal, and I didn't know. I didn't look up what 2009 was. Either my slide was screwed up, but I think it meant to earlier, way before. 11.7 that's a big exemption. Over the last 3 or 4 years, right? We've seen that exempt estate explode.
Right.
So I think they are talking, I think 2009 is correct. They're talking about going back to something more modest.
And one of our attendees said 3.5 million in 2009.
There you go.
So that probably does.
Well, I had no doubt the attendees know more than I do. That's why I volunteered to talk.
Okay. And there's another also question for you is that I guess there have been attempts in the past to eliminate the step up in basis. Mm-hmm. And it was found impossible to enforce and track. So do you think that's still going to be the... I
absolutely agree. I think it's a non-starter, and it's political too. Here's the thing that drives me nuts. And Kate, you guys know this. You deal in this space, so it means a lot to you guys. But the reality is the estate tax is peanuts. It don't mean squat in the grand scheme of things. In the grand scheme of GDP and America's deficits and everything else, the estate tax just doesn't matter. Hardly anyone pays it. It hardly generates any income. That's the good news. The bad news is it's the third rail to politics because you're giving the really wealthy guys a freebie. So it always generates a lot of heat around the subject, way out of proportion to the reality of what's at stake.
That's great insight. Thanks. Thanks for that, Mike.
Well, and that's why when I mentioned that the Hawaii proposal to bring the exempt estate down to only $1 million,
right?
That would be foolhardy because all of a sudden, instead of having 5% or less of the population subject to the estate tax, I think it's a lot less than 5%. All of a sudden, you're going to have over half of the population here subject to it because all those homes on the hillside are all worth more than $1 million. All of us are millionaires on paper. And so that would be a real train wreck. I think that's going to be social revolution if they go to $1 million estate is taxable.
That's so true. Kate, any comment on that too?
I mean, I think Mike's correct. And, we've all seen it go up and go down. But I mean, I think Judy's comment about the enforceability of the basis issue. Yeah. I mean, part of that is just a simple practicality problem, right? Who can establish their basis from 30 years ago? So it's, It's just the step up in basis is a nice fresh way to let everybody move forward. And so I agree with Judy. I just don't think they're going to be able to track it.
Okay, great. Well, any last comments or remarks from our speakers today? I know we just have a few more minutes. I don't see any further questions, but any last comments? Kavena, Kate, Mike?
Yeah, I would just reiterate, I think the tax change is going to be in the second half of this year. I don't think we're going to see Biden introducing anything right now. It's too much on his plate. And the things, if he introduces the things that are described here, it's going to divert political capital and create the division in the Senate that he really doesn't want to be dealing with right out of the gates. He has other things he has to deal with.
Okay, great. Wonderful news. I have my last news is that the tsunami watch was canceled. So thank you. Woohoo. So thank you all for sticking with us during this presentation, and thank you to our speakers as well, and have a wonderful day.